Welcome back to the Future Show here on the TD Ameritrade Network. I'm your host, Ben Lichtenstein, with the Fed minutes this week. The U.S. dollar last week trading back to within 30 ticks of the 2018 high. Brexit had a lot on their plate to digest. This morning we've asked Alan Nuckman, the Chief Market Strategist at Agora Financial, to come on down and help us take a bite out of it. Alan, good to have you back. I want to first get your thoughts Good morning, Alan. I'll first get your thoughts on another wave of weak economic data out of Europe last night, specifically the German Business Climate Index. It came in at 98.5. It's the sixth month in a row that it's declined.
Well, it's the same old, same old. Hasn't had much impact on the markets. The currency markets are calm and quiet for now. It's been many weeks, many months that we've been essentially trading sideways. So I'm not sure what the catalyst is going to be, but we're going to see some sort of breakout at some point. But right now, volatility is extremely low and currencies are in very tight ranges.
So, Alan, let's talk a little bit about the Aussie dollar. It had some volatility the last couple days. First, we saw the Reserve Bank of Australia Governor Philip Lowe, who hinted at a possibility of 2 rate hikes coming this year. But I'm more interested in what you've been hearing about reports that a port was a Dalian port. I'm hearing reports that they banned Australian coal, and ultimately, what does this mean for the Aussie dollar?
Well, that's interesting itself, but I think, as we've talked before, it's more tied to China. Now, China was up again overnight, another couple of percent in the Shanghai. But if you look at China in general, the FXI, and I use that as my kind of barometer, it's broken out of a bottom base, and it's had a pretty healthy rally off that bottom. So I think the worst may be over in China as we continue every single day to talk about the update on trade talks, tariffs, and so forth. I think that could have a positive spillover effect and a positive action on that Australian dollar. I think you can lean against that 70 level psychologically and see what kind of bounce we can get out of that market from a risk-reward standpoint.
So talk to us in terms of how this impacts the New Zealand dollar. I mean, because we tend to watch those two very closely correlated, the 6A, the 6N. And I mean, anything there in terms of any reaction, Alan?
Well, I think it always comes back to our U.S. dollar, obviously. In our U.S. dollar, you know, I don't know how you want to mark it technically, but that action last Friday, if you look at the March contract, that price was a tiny bit higher than, I think it was 1 tick higher than we saw that key reversal top that we had in December. So does that void that top? I'm not so sure, but we did have a quick little unwind where it dropped about 100 ticks immediately after. So again, the equation is all about the dollar, and if we're not raising rates, how can the dollar continue to strengthen? I would like to think that was the last gasp in the dollar index, but I've been looking for that for a while.
Well, Alan, I mean, we could see strength in the dollar if we were to have, well, let's talk about Brexit, because we're actually seeing Theresa May. She seems to be gaining some footing. She's rumored to have changed some of the wording related to the Irish border issues, and it sounds like both the EU and Parliament seem to be on board. Anything concrete, or is this just more of the kind of on-again, off-again news cycle that we've been caught up in?
Well, I think it's a nothing burger as it stands right now. Look, we're just hanging at this 130 level.
Yeah.
I mean, it's there's no movement right now until there is. And again, it's not our job to pick what's going to be the breakout, what's going to cause the breakout. But obviously, looking at these charts, you can see something's going to happen. Looking over at the euro currency, we had lows, obviously, when the dollar made highs. But the euro currency had traded between 114 and 116 for 3 months. And then it broke to the downside. Now that low was 112.60. If you take that measured move of that range, that 2-point range, very simply, you know, 112 was the measured move target. Didn't quite get there, but we continue to see bullish divergence in the fact that even though it made new lows, we were not making new highs in volatility. Volatility is not increasing, so it's not a panic sell-off. It's just kind of a whatever drifting lower. It's just a slow grind in a lot of these currencies right now, but that can change very quickly. You and I have been around a long time, and we both know how the market dynamics can change.
Yeah, we'll have to keep a close eye on some of that economic data. We know the Fed here is a bit more data dependent. As traders, I always say that we should be as well. Alan, this week it was all about the Fed minutes. Next week, the focus for currency traders will be Powell on the Hill. He's set to deliver semi-annual monetary report to Congress before the Senate Committee on Banking, Housing, and Urban Affairs. On Thursday, it's the House of Representatives. This is one of the more closely watched events of the year. Will it continue to be, considering all the transparency that the Fed has provided?
Well, you nailed it, I think, when you talked about the sharp shift. I'm not saying it's political.
Yeah.
I'm just saying it's a sharp
Sure
shift in reality. It kind of felt like someone was, putting some pressure on the Fed to change their course. Well, whatever. That's not our decision to make. But as traders, we can see that, it doesn't look like there's any rate hikes anytime in the future. It's not just this year. You look further out, there's not any hikes coming. So that's what the markets are telling us right now. I always defer to the markets are smarter than I am. And I'm going to go with that right now. So let's just look for that. Those commentaries should build on this dovish attitude and see where we go. But I want to bring this back to the macro market as well. You talked about the S&P. The S&P got up to 2798 in the overnight session in the E-mini. And 2,800 is a really critical point, because if you look at stocks, we've had this huge comeback. This growth fear has been kind of alleviated, and we had a 20% bounce in the Dow, the S&P, and the Nasdaq off those extreme lows. 2,800 is an important point. Technically, the S&P traded sideways essentially for all of 2018, 2,600 to 2,800. We were above that a little bit when we made those highs, but I think we're going to get a little bit more comfort if we can get back above that. Then we're not that far away from all-time highs once again, and that'll make us feel a little bit more confident in the overall trends in the market.
Alan, does that complete U-turn, that shift from the hawkish and autopilot to a more patient and dovish stance, was there anything there, anything that stood out to you in terms of the minutes that was noteworthy, anything that's worth mentioning?
No, but was so interesting to me was for many months before the actual shift, the markets were not pricing any hikes. They had one hike in for 2019, and then they took that out. So the markets forecasted that so-called shift pretty well. So I think people had gotten too ambitious about how that rates would get normalized very quickly. And if you remember, it was last March that people had the meltdown about the 10-year getting back above 3%. So it's really just a psychology shift more than anything. And I think that's what had people scared. But looking at the markets had it right, and and now we've seen the commentary come out and support that idea that they're not going to raise rates nearly as fast as people were worried about.
Yeah, Alan, real quick, I've got one more for you. You actually provided a good segue into the next topic I wanted to discuss, but before I do, I want to take a look or get your thoughts on rates, because for the most part, a little bit of consolidation that's been occurring. I'd imagine with what it sounds like, you feel like the Fed's going to be on hold for a while. You expect this to continue.
Yeah, just looking at that, barring some sort of
unforeseen
flight to quality.
Yeah. Okay.
So I think that's just a path, and I know people are concerned, and you're going to get into this in the next segment, but they're concerned about the consolidation in the rates and the flattening. But with rates at these extremely low levels, I don't think those old rules really apply. One last currency that I did notice, and I know it's in the news every day, so maybe that's why it stuck out. They do trade the Russian ruble. The Russian ruble's been bottoming out, so I don't know that much about Russia, but look at it from a technical that suffered for a long time, so maybe there's some relief for the Russian ruble.
All right, we'll see if there's something there. Alan, really appreciate you joining us here this morning to take a look at some of the currency markets some of the impact that we're seeing from the top stories that have been on the minds of traders here this week, and financial traders specifically.